Investors watching the future of the Federal Reserve. A judge hearing arguments Friday on whether Fed Governor Lisa Cook can remain in her job while the legal process plays out over the allegation she declared two separate properties as her primary residence on mortgage applications. The decision may come next week. Joining me now, J.P. Morgan Asset Management Chief Global Strategist David Kelly. David, it is great to see you again.
Glad to be here.
So thanks for joining us. I want to ask you about your economic outlook, but first, let's get your reaction to the latest on the Fed and President Trump's calls to fire Cook. What are you watching as this dispute unfolds?
Well, I think it's a much broader question than really about any one member of the Federal Reserve. The question is the Federal Reserve going to remain independent? Since the Federal Reserve was set up in 1913, it has been independent. When the law was originally passed, the idea was not to allow an administration and Congress to have control of both fiscal policy and monetary policy. Because, of course, we've seen in other countries where if the government controls the central bank, they simply print money to do all the good stuff they want, and then that leads to inflation later. And so both parties have always regarded the independence of the Fed as being very important. But I think that is being challenged today.
And obviously, one of the issues here is that rate cut. The market is expecting some rate cuts down the road, maybe not as many as President Trump would like. But in the meantime, you've been warning that it may not provide the sort of stimulus that people are actually hoping for.
Yes, that's one of the things I think people sort of forget here. Over the decades, really, the economy has become less and less sensitive to interest rates because it's really a double-edged sword. You know, you cut interest rates, okay, that helps housing a little bit, but it's cutting the interest income of consumers. And when the Federal Reserve cuts interest rates, by 25 basis points or 1/4%, everybody knows they're going to cut it some more. So you want to borrow money now or you want to wait a while? And everybody decides to wait a while. And so that sows the economy. And then people worry, well, if the Fed's cutting rates, they must be really concerned about the economy. And that sows the economy. So it really works both ways here. And what we find is because the economy doesn't react or respond to rate cuts, they end up giving us more. And that doesn't cause the economy to grow faster, but it does cause asset bubbles. And I think one of the curses of this century has been asset bubbles caused by the Federal Reserve moving rates way too low just because cutting rates wasn't effective at stimulating the economy.
One drink didn't do it, so I'll have another. I do want to ask you, going back to fiscal policy, though, you have written a really interesting piece, I saw on LinkedIn recently, about sort of the nuances of the tax cut and the timing of the refunds. Can you explain that?
Well, yes, and I'm really surprised that more people aren't paying attention to this, but when they passed the OBBBA, it was deliberately designed to generate a bumper crop of income tax refunds early in 2026. They could have put all these new tax cuts, the tax cut on overtime and tips and this standard deduction. They could have put it all as being effective as of January 1, 2026. But they deliberately made it effective January 1, 2025. That means that people have paid too much tax this year because they didn't adjust the withholding schedules, and they're going to be due a very big refund next year. The average refund runs at about $3,200 this year. We think it'll be somewhere in the order of, close to $3,800, $3,900, maybe even $4,000 next year. That's going to act as a big stimulus check. And you remember the stimulus checks? Well, there's good and bad to the stimulus checks. It'll cause economic growth in the first half of next year, but of course it also could sustain inflation. But I think this is a big part of the outlook that people are forgetting about. There's a lot of income tax refunds coming early next year.
So meanwhile, the backdrop in the markets is very steep valuations right now in the U.S. You have been recommending that American investors look overseas. But of course, we've been hearing that for a long time. And yet America seems to be developing and maintaining the most innovative, disruptive companies. Tell me why now is the time that we all ought to really look at our 401ks and make sure we've got an adequate overseas allocation.
Having an appropriately diversified portfolio or account, it's a little bit like having home insurance. You never know when you're going to need it, but you should never feel comfortable not having it. Something could go wrong here. And the U.S. stocks now represent 65% of global stock market valuations. They're priced about 50% higher relative to forward earnings than overseas stocks. So overseas stocks are significantly cheaper relative to U.S. stocks. And also, people are very overweight U.S. I mean, people have, even if the U.S. is 65% of the global stock market, most people have got much more than 65% of their stock exposure in the U.S. And something could go wrong here. And the rest of the world, there are opportunities. It is growing. The dollar could fall some more. That pushes up international returns. So I just think people should try to get to some balance here because these have been some very good years. But there is risk out there, and I think people need to pay attention to that.
And year to date, the ex-U.S. index is beating the U.S. index, so maybe we're at the beginning of a long run. David Kelly, thank you so much for coming on the show. Good to see you.
Anytime.